Howdy, Jacob here. Today we're looking at Vector Group, ticker symbol VGR. We see it has a $1.6 billion market cap with a $2.4 billion enterprise value in the tobacco industry. Looks like it was founded in 1873 in Miami, Florida. So been quite a bit. 1.08 billion in 2013 in revenue, up to 1.4 billion in 2022. Return on invested capital recently has jumped immensely to definitely double digits, whereas prior it was upper single digit return on invested capital. They currently have a 7.4% dividend yield. Let's look at some of this debt here. We see $1.39 billion in long-term debt, a little amount of short-term debt, and then $225 million cash and equivalents, 116 short-term investments, so about $340 million in cash-like equivalents on their balance sheet, and then $1.4 billion in long-term debt. So a good amount of long-term debt compared to their liquidity. Their 5-year average free cash flow is probably about 170, 100, let's say 190, 180. Okay, 5-year average 180 million. They pay out 126 million in their aggregate dividend of 7%. So although that's a good amount of their dividend, about that probably about 65 to 75% payout ratio. Their other use of cash is really just a little bit of acquisition and maybe a little bit of reinvestment. But it doesn't look like there's a lot of it. So it looks like they just give a lot of their excess cash to shareholders. So nothing wrong with that. And where's the? I was just wondering how their return on invested capital jumped so much, but I guess I won't look at that until I do a deeper dive. So let's start making some assumptions here. I feel like the business, other tobacco companies are trying to go smoke free, so I'm assuming they're trying to do the same. And so maybe 1%, 11, maybe after 7 years, they still have a tiny bit of growth ahead of them, but nearly flat. And then as for margins, they've gone up a lot recently, but I'll probably still do an average because I don't see why it would have jumped so much. And then let's see what a 2% bump would do to their long-term debt. So about 1.4 billion, 28 million, 28 million compared to their roughly 180, 190 million free cash flow 5-year average is not too much, maybe 15% or so. So I'll bump the margin 15%, 9, 13, maybe let's do 8, 10, and then like 1% increase in shares. I'm fine with the dividend as is. I think that they should start focusing more cash on paying down debt. So maybe I'll cut it 25%, and that payout ratio declines to about 50%, and then the rest of their cash, hopefully at least 25+% excess cash flow is then going towards paying down this debt. And so this gets us to a price point that the company's stock price need to fall 45% before you get a 15% return, given these assumptions. I think if you're looking for dividend yield, 7.4% is pretty good. They have a little bit of debt on hand, so you're going to have to look at when all that's due and see if that's concerning to you or not. But even if they cut it 25%, you're still looking at over a 5% dividend yield. So again, if you're looking for, it just depends. Every investment of a company is going to be personal based, and whether you're looking for this, that, or the other. For me, as young as I am, looking for just as much return as possible. And so I think this could definitely, if you are interested in investing in tobacco stocks, I know a lot of people aren't invested in some sin stocks or sin companies, then I understand. But if you don't mind and you're just looking at the business for the business that it is, I think this could definitely be something to add to a dividend yield screener. And then once it gets to a more attractive price, maybe pounce on it. So thanks. Have a good rest of your day.